Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Jeremiah Boucher. He is the founder and CEO of Patriot Holdings. Patriot Holdings is a real estate private equity group based in Las Vegas, Nevada, that specializes in investing and improving alternative commercial real estate assets, most notably mobile home parks, industrial assets, and self-storage facilities. Patriot Holdings strategy involves purchasing off-market assets through an extensive property database and deepened relationships built over the last 2 decades. Their team makes value-add opportunities including expansion and ground-up development, then installing remote management processes to maximize the revenues and income from the properties. In total, the organization owns and operates over $350 million in assets. So, Jeremiah, welcome to the show.
Thanks, Keith. Yes.
Yeah.
Let's jump into it.
Yeah, let's do it. And you got started at an early age, and maybe if you could just let us know your story. Where did you grow up, and what eventually led you to real estate?
Yeah, I grew up in New Hampshire as a kid. My mom moved to Vegas. I went back and forth. My dad has a paving company, so I got to get my hands dirty growing up as a little teenager and throughout high school, and pretty lost after not being able to be an athlete at the next level. So I played rugby and for a year in college and partied it up really hard and figured out, that wasn't for me. So real estate was where I landed, and ended up just really seeing the value in it by reading just a cheesy course, No Money Down by Carlton Sheets. It was in my dad's basement, and I said, okay, I can do this. I mean, I can control my own destiny. So I was just bit by the real estate bug, and I've been addicted to it since then, and been done pretty much similar to your career, all types of investing, every single asset class type. Started with residential and all types of commercial, and took a lot of different courses, and I lost everything in 07, 08 here in Vegas, where I had a handful of houses that couldn't support the debt, didn't have an advantage or an edge in the market, didn't really understand the fundamentals, or at least even if I did, I was probably caught up with greed like everyone else, right, where you're buying and selling homes and making all that money, and then really, but it really, I saw the writing on the wall where I didn't like that game of not having some creative advantage or something that I could actually move the needle on the asset by having skills in a team. So I knew at that time, after reading Dave and Frank's Mobile Home Park Boot Camp book and going one of their boot camps back in 07, 06, 07, 08, that I didn't want to be in residential anyway, even if there was a lot of money in it. And I really saw the value in mobile home park investing, where the asset class takes a lot of expertise and hands-on work to really maximize value. And there's a lot of inefficiencies because a lot of people don't want to put the work in. So I went on a tear and called up Dave and Frank and said, hey, I pretty much lost everything. I'm a 25 or 6-year-old kid, and what can I do to get into business? And they said, buy this list and go out and find some deals. So I hit the phones for 10 years and really sourced about 80, 85 deals to those guys or more, and ended up getting some fees and getting some different equity participation, and helped those guys grow their fund to all the success it is today.
Yeah.
And in turn, Dave was my mentor, and so was Frank, and taught me the business. And I really gravitated to the MHP business. And at this stage, though, I decided I wanted to pivot to storage and do some small bay industrial, and tried some other asset classes along the way that were a nightmare. And I can answer all the questions that you have.
Okay. No, that's great. Well, that's really neat. So that you started kind of working for them as far as just being able to try to find deals. Can you maybe tell us a little bit about that and what you learned along the way as far as, just cold calling? We actually just closed on a park on Wednesday, right before Thanksgiving, and it was done through that, just looking up owners' names and reaching out. I actually knocked on the door because they were here in San Antonio, but yeah, there's definitely a way of getting in touch with the owners that way. So,
yeah, it's my favorite strategy. I just don't have time to do it, but I have 5 acquisition staff, and we primarily source probably 85, 90% of our deals from that. And I would say along the way, the data is important. I mean, you have to know how to get a hold of the owner.
Mm-hmm.
So it's a lot of research and you can pull all that through MH Village and looking up each tax. They give you a list, and then you look up each tax record, and you can call the park itself and just ask for the owner. But once you do that, you really have to approach it from a very personable, very non-attached, I'm sure the way you did it, Keith, was just very, very down to earth type of presentation. And it's very simple. It's, I'm Jeremiah. I own other mobile home parks, or my partners and I own parks. We're looking to buy more. I really like the area. Would you ever consider selling? And just so you announce who you are, why you're calling, the fact that you have other assets or someone knows something about it that works with you.
Yeah.
So you're not just legitimate. And then you just state the intention. And then it really never happens on the first call. I'm sure you had to knock on their door and had a continual follow-ups with it.
Yep.
But over time, that trust was built, and that 10 years, the snowball effect happened years into it. It wasn't the first year, second year. It was years, 4, 5, 6, 7. That's where the real momentum occurred, because they knew I just wasn't going away. And it's just, this guy calls twice a year for the last 6 years. And for us, we do what we say. You're honest, you're direct, you don't overcomplicate it. You try to simplify the process as much as possible. I mean, with these type of unsophisticated owners that know their asset well, but one, probably don't want to invest all the time and energy into upgrading the asset when it comes to technology or some of the big capital improvements, or buying brand new homes and filling them in. And two, they want the process easy as possible. I mean, that's really why they're working with you and not a broker.
Right.
So make it easy. And if you have to sit there and go one by one, do the rent roll and hand write it, then just sit there and write it. And don't overcomplicate it, because I see a lot of people make it difficult for these people, and these people get frustrated and they don't want to deal with anyone.
Yeah. I've seen that myself as well. That's interesting. And then what? So as you're finding these deals for them, when did you start to? You said that some of the deals you got, had equity in and whatnot. But when did you buy your first one that was maybe just all you?
I got in right away, 2010.
Okay.
So, I mean, along the way, I would buy 1 or 2 here off, but I had a foreclosure. So at that time, I had to look for only seller financing.
Right.
So I wrote a book called Finding Your Edge, How to Win at the Game of Commercial Real Estate. And I just tell the different stories of a lot of these different deals and how I got involved. And there was some funny, fascinating people I've met. And but at the end of the day, if you could find somebody that wants that retirement income and they don't want to reinvest in another asset or in another real estate property, you can create a win-win, right? And I'm sure you've done it in the past. But if you could give them a down payment and make payments to them, $3,000, $4,000, $5,000, $10,000 a month, and they can get that nice stream of income, and you take on all the management headaches. If you're willing to do that, it's a good way to get into the business, learn it, add some value, and then get a good loan that take your the seller out, pay off their loan, and get some of your cash back.
Right. Yeah, exactly. That's cool. So, and then so is that primarily what you guys do now, or have you pivoted a little bit more into the self-storage and some of the other asset classes?
Yes. A few years ago, it was very difficult as more and more people came into the mobile home park space to find properties I felt comfortable buying with a good margin of safety. Like Buffett talks about. The challenge is, with parks, a lot of people know the pros. The cons are a lot of deferred maintenance. You're going to have to be prepared to improve sometimes the power system, definitely the water and sewer lines. The roads are typically pretty beat up. I mean, the communities that I think this investor base that your listeners look at and invest in are typically, they use a star system or a C class. It'd be comparable to a C class apartment. Right. A and B class communities trade with public companies, right? Some of the bigger public REITs that are in large markets like Florida and Texas and California. And those are a different clientele and a different asset class many times because they are somewhat newer and they're a higher quality. So the properties that you can find double-digit returns in within 10, 15% cash on cash returns and 20, 30% IRRs, those are going to come with a lot of headaches. And if you don't catch the market correctly, we're in a high interest rate market like now, where their investors aren't overpaying, you don't have the leeway to buy it at a premium, and then you misallocated or you misestimated the amount of improvements it takes to really elevate the community to standards that are needed 30, 40, 50 years after it's been built. And you're going to find yourself upside down because your cost basis is going to be more than if you could sell it, which is okay if people have a longer term outlook. But the problem is if you have to refinance or if the cost of the debt accelerates or you had to put in a lot of extra cash that you didn't anticipate, then the returns start to diminish quite quickly. So you really got to approach mobile home communities with a very with a comprehensive view of not only what is the return today, and where can I raise the lot rents that are affordable and comfortable for the residents, rather than just jacking rents up and really hurting people where they can't afford those rents.
Right.
And then secondly, like what is going to be those costs to improve the assets if the septics go out, if there's a treatment plant or wells. I mean, those are big CapEx items. So you got to be very careful now when you do that. And I just decided to step away for a while where I still have roughly 10 communities. I have 6 or so that I really want to make legacy assets, but it's a lot of operations. I mean, it takes a lot of property management and we can get into that. But for the most part, once it's stabilized, there's not a lot of operations if you have a good property manager, but it's more on the improving the asset by buying brand new homes, filling those lots, selling those lots, marketing the business. I mean, you're essentially like a realtor, just like you run in your office. Mm-hmm. You're running the role of being a realtor and getting people qualified and selling a home, and you're property managing and asset managing because you're improving and you're making sure that the asset itself, that collections are good and your investors are happy.
Yeah, for sure. When as you were buying those 10 communities and any other ones that you did, what was kind of the buy box? What were you looking for specifically?
Wow, in the beginning, it was anyone that would sell it.
Right. Yeah, I understand that.
I bought some tough stuff, man. I bought one that was 37 pads in Davenport, Iowa, that had sex offenders, and I didn't know what I was getting into. It had a treatment plant. It had an old motel next to it. It was on. There was no rent control, but it was a rough asset, and I got out of that one 7-8 years ago. But so I bought them all. I bought stuff down to 15 pads up to 300 pads or more, 400 pads. So
okay,
I had it all.
Yeah, that's awesome. What were some of the things that maybe in both working with Dave and just in your own investments, what were some of the things that you liked about the mobile home park as an asset class?
Well, I'll tell you, maybe, like just to give people practical advice, and with yours, Keith, I'm not sure the location, but parks typically were built there's different areas. So sometimes they're in the boonies, and I've noticed every time I'm out in the middle of nowhere, and you're not close to services within 10, 15 minutes of say a Walmart or Dollar General or some type of retail at hospitals, a decent town. I just never had any luck with those. If I was out in the middle of nowhere, it just wasn't where I wanted to invest my time over the long haul. I could never sell homes. People could barely afford the rents. So, I mean, if you could be, and if I would say now we don't look at anything really under 70 or 80 lots, ideally it should be a couple hundred lots. I know, which for us, I mean, I'd rather just be picky and take on one community a year than do volume.
Yeah.
Because it's really the same amount of work it takes on a 50 unit pad and a 400 unit pad. It's the truth.
Yeah. Okay.
I mean, other things I look for, obviously no park owned homes. I mean, but you have to take some. But in general, less than 10 or 20% of your tenant base, you own the home. That's just a nightmare that if you're out of state owner, I wouldn't touch it unless you're really into rehabs and that's what you want to put your time and energy into. Obviously city utilities are good, but you're not going to find as many inefficiencies. So if you can find some that have banged up septics, you can kind of use that as a negotiating tool because septics in general are still a pretty common way on the East Coast of handling sewage disposal, and it's not the end of the world. I mean, it's not cheap, but it's not crazy expensive. But you do got to watch when you have a treatment plant or lagoons.
Yeah.
I mean, those big ponds, sewer. There's a lot of leverage there if you're willing to get your hands dirty in terms of re-engineering a system and rebuilding it and having a plan. But I would not overpay. I mean, you better build in a big margin of safety because the state Department of Environmental Protection agencies are cracking down if you don't have somewhat of a modern system there. So that's something that there's like in my book. I mean, you always have to have an edge, and you could have an edge there.
Yeah.
Just make sure we all make our money in real estate on the buy, not on the sell.
That's right.
So buy it right, and then you can create that advantage up in the front because other people aren't willing to take on that risk.
Yeah, for sure. Oh, cool. And what about some of the stuff that you're doing now with industrial? I keep hearing a lot of buzz about industrial right now, and there's a lot of shifts and changes with manufacturing coming back to the U.S. I don't know what type of industrial you've been kind of diving into, but
yeah, well, I mean, like I said, a small bay is really essentially what we're building. So what that means is you call it different things, right, in different markets, but flex space where you can have a little bit of office, you have a warehouse. For me, I mean, you see it all over Texas. I like the metal buildings where you get a man door and you get a garage door, and it typically is 40, 50, 60, up to 80 feet deep. And then you have that individual space that typically they're free span, meaning there's no columns. So you can just build a wall or you can leave it open, and they can take as much as the 10,000 feet or whatever the building size is, or they can take 1,500 square foot spaces every unit. But what it is, it's contractor base. It's office and warehousing for contractors that typically focus on service-based items of landscaping, plumbing, electrical, siding, all the different trades that these guys, someone's got to do the job, and these guys need a place to go. And if they're somewhat successful in their business, meaning they have more than one fleet of a truck, you can't stay at your house if you live in any type of community,
right.
Anything in towns now. You can't have a fleet of vans or trucks in front of your house. So they have to go somewhere, and they need a little bit of office space. They need a little bit of yard space. So I'm so bullish on this asset class. I love it. I just think that it's in huge demand, but you just got to be able to, for me, I got to allocate my resources to focus on our strengths. So I want to make sure I can do 1 or 2 or 3 projects slowly, get good at this system, and then in the future, put a little more effort into it. But it's by far not easy to develop this stuff. It's not complicated either, but it just takes a lot of focus and effort, and there's a lot around it to walk into building a business park.
Yeah.
But the product itself is awesome, man. I would do 10 more if I had the staff and resources right now for it.
What area are you specifically investing on that? Is that out in Las Vegas or a little bit of everywhere?
No, it's mostly New England. So I went back Primarily my portfolio is in New England, meaning the 6 northeastern states. New Hampshire's my home area, but Maine, Massachusetts, Vermont, Rhode Island, Connecticut. And I find that there's a lot of well-paid tradesmen or companies, and there's a lot of density in those markets, and it's in high demand. And we're still able to get away with a metal building without too much of a upgraded facade, so you can keep the cost under $100 to build all in.
Right. Okay. And so for something like that, and I know it's going to be, different depending on the market, but how much is that leasing for?
Yeah, the magic number for us is you have to get, I know out west they use it $1 per square foot. You have to get $1 a foot,
okay,
or $12 annually, triple net. That really gets us, I think, right now we're closer to 16 to 18. We're $13 triple net, plus it's about $3.50 for the nets.
Okay.
So we're at $16, $17 gross, and or $13 net.
Okay. That's interesting. And the end user and the person so are a lot of these projects, Jeremiah, you're actually developing them from the ground up and leasing them out, and then are you holding them, or are you selling them to other investors, or what does that look like?
Yeah, I'm sorry. I will show you, what we're building. Just, do you mind if I share my screen here, Keith? Yeah, I mean, this is essentially the product, just so people visually, it makes a lot more sense. Can you see that okay?
I can. Yep.
Yeah, so those are the 3 buildings that we're building. And why I like the project here is if you look where my mouse is, I think the best way for a new investor to enter this space is buy existing commercial or industrial and then expand. So this is a small dance studio here in Somersworth. It's got a really good name in the community. There's 100 or a couple hundred kids that learn dance here. There's a patio furniture guy out of here. So we had some cash flow on the asset itself. And this region is in near the coastal region of New England, which has the University of New Hampshire, UNH, has a bunch of hospitals. It's near interstate highways going north and south, and up into the mountains, into the lakes region, which is very popular. So it had a good location. It also had another tenant here where it was a ambulance company, a servicing company, where they transport people to Boston when they need higher medical services than are available here. So, buying this asset for $1.2 million and basically getting an 8 or an 8.5 cap based on the actual existing tenants. This was 3 years ago or so. Plus, I got the 2 acres in the back that was already approved for industrial development. Now I had to come in here and get the engineer, which was a nightmare to get this thing finally approved due to some poor engineering on laying it out. But overall, we got what we wanted. We got 40,000 square feet in the back. Essentially, the land was for free, and we're able to still hit our marks where we built it for under $100 a square foot, and we're leasing it up at that. Actually, rents went up over that time, so it ended up waiting actually benefited us. Where now we're getting that $12, $13 triple net.
Okay. And then what about on the terms of the leases? What are you typically going after time frame as far as leasing it out?
Yeah, it's a really good question. I have mixed emotions about where I want to bring the business. At the time being, we're doing a blend. So, I don't mind the 1 or 2 year leases. I think at this stage with the amount of inflation that is prevalent in the economy and the possible future inflation, I'm not afraid of short-term leases. I'd like to help the business get established. And then at that point, we can raise rents as inflation continues to drive values in the economy. But then also, to have a margin of safety and have half the leases on 5-year leases where we do 4% increases ideally because inflation's high. It helps them get established in the space, but they have a fixed amount that they have to guarantee.
Yeah, makes sense. And what's this one here?
This is the buildings that we bought. They're called heritage buildings. This is that product that we put up in real life.
Okay.
Yeah, and then there's tons in here. If anyone wants, it's on LoopNet now. It's taken way longer than we expected, but but it's getting there. We finished it. There's good signage. It's good. Everything ended up working out really well on this, but it's not for the faint of heart development.
Yeah, for sure. Well, I mean, I like the way that the project went as far as just having an existing tenant, actually two existing tenants. So it's already cash flowing some, before you actually start the construction versus if you're doing development from the ground up and, having to wait out until you start having a complete product that you can lease out.
Yeah, I mean, that helped with our, at the time we did a syndication on this, and there's a handful of investors, including myself, in order to still hit distributions before you're drawing on your construction loan. And during your construction loan, you're still able to pay the construction interest. That's very helpful. You're not doing capital calls. You're being able to give a yield. You're not tying up the money for 3, 4, 5 years with no distributions. So I think it's a good tactic for anyone that's thinking of development. If you're not doing it, day in, day out, this is a good start as an entryway where you have an existing asset that you can expand.
For sure. And have you done some others that were kind of a similar format where there was, already something existing and then you developed and built onto it?
I bought an existing asset in Connecticut. If you guys don't mind, I'll just bring it up here. But sure. It's a nice existing small bay industrial that we still haven't got permits to expand, but we didn't need to. And this is near the University of Connecticut, UConn, about 20 minutes outside of town. It's not in a dense area, as you can see here. I mean, this is a lot of farmland. I could show you if I go out a little bit here. You have the university here in Willimantic, and then you have, Norwich and New London, which there's a lot of employment here with some of the guys that built the subs. What do they call? General Dynamics. So there's a good employment base, a good cost of housing, and there was a need for these types of contractors. So, on the surface, it looks like it's out there, but I'm sure a lot of your investors just look for some of these projects in suburban towns. And I really like this one where it doesn't do it justice, on the aerial, but looking at it and being able to buy it around, I think we're at $40 a square foot. It was a real clean product, as you can see in there. It has, and this is a mixed use. I know you see this a lot in Texas as well, where, on the front, this is a daycare with kids, and they are a good paying tenant, good ratings in the community on Google, and never have issues paying their rent. And then here you got all the small bay, different contractors in the back. And, the big thing I'd have to say, Keith, is I was so surprised on how, the management is so important, where just getting this sign up, getting some of our tenants on here and getting a phone number and getting on Craigslist and Facebook, we were able to fill it up immediately and get $12, $13, $14, up to $18 gross rents when you got one small space. So it was just a function of just people not managing it, not using technology, not picking up the phone.
Yeah.
And we just did 1 and 2 or 3 year leases.
Wow. Okay. And maybe talk to us a little bit about, some of the things, some of the levers that you pull like that, signage seems like something somewhat basic, but I guess on these, that's kind of important to be able to know what businesses are back there. And then, what are some of the other things that you found you can do to improve the returns?
I mean, you have to do the improvements in the asset. So we didn't repave it, but, painting it, pressure washing it, getting the landscape dialed in, getting the sign dialed in, and honestly, we don't even have our website for the business park even up yet. We're still working on getting a template that we can put in there where people can pull a brochure. You can get a good leasing agent out here. But we did it in-house with our property manager, just getting signs that we had space for lease and get it out on Craigslist, get it out on LoopNet, get it out on these guys don't really use commercial brokers too much. So get it out there on Facebook. And now I know they've changed marketplace around and it's a little tricky to do that as now, but just the basics of there's nothing really fundamentally major you got to do. You just got to do the basics and consistently do them and then pick up the phone and, get people an application and try to help their business get moved in.
Yeah. Okay. It's pretty neat. And what do you use? How do you manage it? What do you use for a property management software?
Yeah, we've gone back and forth with AppFolio and Rent Manager because of, we self-managed it in the beginning. We were more focused on storage. So I don't think we did the asset justice, my staff. So we actually worked with a really good property manager up in New Hampshire, and they manage now all our commercial assets. And we stick with Rent Manager, and now all the tenants pay through a portal, which is just a landing page on the website. And they put in, now we don't take any more checks or cash. It has to be actual ACH or a withdrawal from their account through the portal.
Okay. Are you doing that with your mobile home parks as well?
Yeah, we are. I can't say we do 100% of that. There is still about 5% or less that they're just good tenants and older people, and we kind of let it slide.
Right.
But not any of the new tenants. Everybody has to go to the Rent Manager portal to pay their rent.
Okay. Yeah, it makes sense. I could see it a little bit, having that flexibility on the mobile home park, just because you're right. There's sometimes people that are just old. They're paying with money orders or whatever. But sure is convenient when it hits the bank account versus having to go make deposits.
Yeah. And then if you just want to kind of look, your audience wants to see one of the long-term mobile home parks that I'm holding, and one that I feel I did a great job on it. My dad paved it. We demoed some homes. This is 79 pads here in the same region around southern New Hampshire, around the eastern part of the state, where it's very similar to where that industrial property was we're building. But really good proximity to services, even though it is a bedroom community. I mean, you're not in the middle of any major town, but that's fine for mobile home parks, especially in a region where housing's $400,000, $500,000, $600,000 for a median cost of a home. That really changes the landscape of the people's perception of living in a mobile home that's $100,000 or $200,000. They're excited for that. So that's something that you always want to look for. And we bought this community where it wasn't in rough shape, but it wasn't that pretty either. A lot of septics we had to rebuild. That was a big CapEx. It had good sized lots. I'd have to tell people here, as you can see, people can get a nice yard, which people really value. That's one of the reasons why they live in a mobile home park. We paved all the 80% of the driveways, and we worked that out with some of the different tenants in there, where we'd pay half their driveway. They would pay for the other half. And then we paved all the roads, like I said. Obviously, you get a lot of snow. Good wide roads coming in. Now it looks beautiful. We don't own any of the homes. We're just selling the homes. So right in here, there's 79 pads. We put in 11 homes. I think we have up to 13 we can fill. And we're selling them pretty quickly out here now. There's maybe 3 or 4 left. And then the final phase would be doing an expansion here, where we're working with the town to get in another 6 or 7 lots. I'll have to tell you, you get these you could look at the rooftops. You got shingled roofs. Yeah. You got newer homes in there in the last 10, 15 years. You got good wide streets, and you got 80, 90% occupancy, and you can start replacing the homes and putting brand new ones on the older. These are the ones that you never want to sell, Keith. These are the ones that are... Yeah. These are going to last a long time, and these people are very happy to live here, and we're happy to provide such a nice park for them. And you're going to be able to raise rents $25, $35 a year to keep up with inflation. And there isn't a lot of management after you've done all the things necessary to get it stabilized.
For sure. And what about, tell me a little bit about on the New England states. I mean, some obviously there's... going through COVID, rent moratorium and stuff. Have you experienced any of that with yours, or has it been pretty easy going?
It was not easy going. I mean, but everyone acknowledged that they needed to pay their rent. There wasn't the expectation, I think, in what I've heard in other states like California, where the people just didn't think they had to ever pay rent.
Right.
I mean, we did. We had some challenges in Vermont. But in general, most of the states, our collections were outstanding.
Okay.
As our residents knew that they owned their homes, they were getting a stimulus check. They understood the value of paying their rent quickly and making sure that they don't get behind because of how valuable that housing was. I'm sure Texas was one of the huge markets, and so is Northeast, everywhere. Housing values just skyrocketed.
For
So
sure.
they knew the value of their home and their lot, and they did not want to lose it.
Yeah, makes sense. Oh, that's neat. Yeah, it looks like a great asset there. What about the water on that one? Is that one city water or?
It is. That was one of the stronger aspects of this. Is I've had some challenges with well water, and I'm not against it, but it is liability there where, sometimes you can't control the quality of the water because you never know what's in the soils or what's abutting. This one, we do have city water, and I cannot remember if we sub-meter yet on this or not, but yeah, we typically do sub-meter on most of our communities over time.
Okay. Interesting. And you've done a little bit of everything beyond just that too, right? You've done some gas stations, I think I saw, and some other stuff. Yeah. Tell me about maybe some of the other investments that you've done. For a little while there, I was selling gas stations actually as a broker, and it was always a kind of a different animal altogether, but very fascinating, some of the stuff with it. So,
yeah. How do I answer that? The conclusion after gas stations and even other types of commercial real estate, you don't want to own the business. I actually own the business. Me and a partner owned two different businesses, and we operated it. And there's a lot of moving parts, a lot of inventory. I learned a lot about business, a lot of theft, a lot of reporting. If you don't know how to run one of those, it's not worth running one. The margins that you get on gas and on even your C-store, it's so minimal. That's why we all love being a landlord. I think the inception of real estate, the word itself, is royal status in Spanish, in Spain. So, anyone that has the land, or the gold makes the rules, and the land is what you want. So, hey, if you have an operator there and you can buy a gas station, as long as you can get your phase one and there's no issues in a phase two environmental, they're great assets as long as someone else is handling it. I would look at the operator, though, and make sure they have more than a handful of stores, because if they're just a one-off operator and they're running yours, they probably are barely getting by, and they might have some issues if they're not a big branded facility where the fluctuations in the gas prices can really hurt the operator, where you can make a ton of money, but you're a commodities dealer and you got to buy gas at the right time, hold it in your tanks, sell it at the right price. And sometimes you get caught where you run out of gas, you got to buy it at a higher price. And then the consumer price goes down and you're going to have to take a loss and sell your gas at a loss. So it's a really tough game to play. So my advice would be, look for guys that are, quality operators with a national brand behind them. Look at the assets as a triple net lease and make sure you get your environmental. And yeah, there's a lot of opportunity on those because they're great. They're hard corners and it's valuable pieces of real estate.
Right. Okay. And what about, what else have you done beyond those?
Yeah, office is a nightmare. There's so much deferred maintenance on office space. I'm actually looking to buy my own office here in Vegas, but that's a unique situation where it's just, I'm an owner user, but I expect to get a great deal because right now I'm seeing leasing is slow. I don't know about these trends coming back with people, utilizing half as much as office as they did before, these companies. Right. So I would stay away from office. I think retail is, from my understanding, my buddies that are in it and from what I bought, as long it's all location driven and service-based retail is doing better than ever.
Yeah.
You can't replace it. For myself, though, as a small, I'm a mid-sized investor, but when I was starting out as a small investor, I found I was spreading myself too thin. But I needed to learn. So I bought a small little retail building here in Vegas. Luckily found Liberty Tax. There was a Statue of Liberty on the property, and it was kind of an iconic thing here in Vegas. So I got a hold of Liberty Tax. They ended up leasing the space from me, and I was able to sell it to a California 1031 buyer. But it took so much work, and there was so much hands-on attention that I needed to give it with the improvements and the permits and finding the tenant. And at the end of the day, it's just something I didn't want to put all my energy and resources and staffing into when I started hiring people, that I would pick one or two asset classes and focus on those rather than being a one-man guy trying to do all 6 or 7 different asset types.
Yeah, no, makes a lot of sense. You got to kind of focus a little bit. I have a hard time focusing myself. I'm a little bit all over the map, but trying to remain focused on just mobile home parks right now. So
yeah,
but
it's more than enough work.
Yeah, for sure. And as far as the mobile home stuff, you worked under one of the greats, right? At least in this industry, you got Frank and Dave, and they're like the 5th or 6th largest owners in the U.S. What were maybe some of the top couple things that you learned from kind of working alongside those guys?
Yeah, I mean, Dave, I learned a lot about a handshake agreement, and just he's a really solid guy. Once you say something, you do it, and you trust your partners, and that trust allows you to move quickly when you don't have time sometimes to paper everything up. Yeah. And I'm running, and I treated those guys good, where I gave him first shot on anything I found. He treated me good and always made sure I was taken care of in the partnership or got a fee. So it's just this really good direct communication. Dave reminds me of, like, I'm a big Patriot fan, like a Bill Belichick, where it's just cut to the chase and it's just no emotion, but he's got good values and ethics and character. So that alone, I mean, that taught me a lot in business. Just operate from that place of solid character and be pretty direct and forward about your intentions, and that's going to get you a long way. And then in terms of the assets themselves, just things to look out for with people doctoring up rent rolls, a bunch of park-owned homes that are garbage, and really doing the due diligence, taking that extra time and getting in there and looking at them, looking at the utilities and hiring vendors to come in and inspect the plumbing and the wells and the septics. I mean, those are ticking time bombs, and don't run away from them, but make sure your eyes are wide open with what you're getting into. Talk to the city. I mean, there was a big thing of always asking the city, hey, this is the park. Is it in compliance right now? Is it grandfathered in to be able to replace homes in this? I mean, there was a lot of circumstances where other people or we could have got burned if we didn't check on that, where the town didn't want that park there. Yeah. The zoning and the code wanted they would restrict it. And I've had to have attorneys come in and say, no, this is a grandfathered use. This is affordable housing. And actually, New England is pretty good for that, where the state helps fight some of these towns that don't want this type of housing. So that was a big thing, is looking at the towns and zoning and making sure to get those approvals up front, that there's a form that we would use to have them fill it out in writing, that we have the right in use of all these lots in the park. And then just learning things about seller financing and presenting it where, you're helping reduce tax load on people, and you can help them get a nice, passive income if they carry the note. And Frank was really good at looking at a lot of the potential tenant issues. Is just making sure that you get in there and address that stuff right out of the gate with violations, and getting somebody there on the park to help you out. You got to have eyes and ears on the park. I mean, if it's a greeter or if it's a full-time property manager that lives there in the beginning, if you don't have a big staff, you've got to have somebody there protecting your interests, and they have to care about the community, and they have to live in the community. So that way you have a relationship with your tenants, and you're not checking on your park every 3 or 6 months or a year, and you come back and it's a junkyard.
Right. Yeah. It'll get that way pretty quick too. It just seems like before having any mobile home parks, I don't know if you've seen the same thing, but I can remember the first one where I've never seen people, when the not the dishwasher, but the washing machine goes out, they just push it out the back door. It just sits there. It's like, okay, come on. Could we not have gotten rid of that?
Yeah.
But
I know. It's something, but I would focus on communities that have potential. And what I mean by that is, if 80 or 90% of the homes are pretty dilapidated, you got real tiny lots that you can't replace the homes, and there's just not a quality or pride of ownership in, at least a quarter or half the tenants, I wouldn't want to fight that battle.
Yeah. Makes sense. And then Jeremiah, do you have anything right now that you're raising for?
Yeah. So we're wrapping up our funds, our Fund 3 and Fund 4. We're just about closed in Fund 4. So that's a $25 million raise, and there's about $1 million left. We're wrapping it up by year end. Majority of everything is storage, a handful of mobile home parks in the funds. And Fund 3 is a development fund, so that we have higher depreciation for many of your investors listening. Longer term return profile, no cash flow the first 3 years, but brand new assets built at a very good cost basis, $70, $80 a foot with land. And then in the end, there's a good multiple on them, but you got to be patient to be that type of investor. So wrapping up that one as well. And I think I'm just going to keep sticking with that. We do, typical $25 million funds. We raise over 12 to 18 months, go out and buy $75 to $80 million in assets. And then we pay our investors anywhere between a 6 and a 9% preferred return, depending on how much you invest. And there's different classes of shares. And you end up getting, between 60 and 80% of the upside of the deal. And it's just a very steady kind of track record or kind of system that I've been doing the last 3-4 years, where the funds make more sense. It just doesn't make any sense anymore to do one-off deals where I got to get 5 different people to agree to put the money in and propose the deal to them, and somebody disagrees at the end, or their wife doesn't want them to invest, and now I got to fill that gap. So the funds work really well, and they deliver a good, diverse mix of assets. So one outperforms one of the other ones, one of the maybe underperforming in the time being. No one's panicking because there's that diversification where we're focused on the same asset classes, and we're focused on really, our core markets, but we got we got 15 to 20 assets in the funds, all supporting the investors' returns.
Yeah. How long do you usually leave those opened for?
It's a 5-year life. I think some of the ones, my goal, to be candid, and I've shared it in another podcast, is, a 3 to 5 year life I just sell the majority of the storage to one large operator, one big public REIT or private equity company. And we have 70 plus sites now, and we should be at a couple 100 or 150 storage sites. I think there's value to an aggregated portfolio as a one large transaction. And then on the MHP side, it's just being prudent, being very picky. And then at the end of 5 years is selling it or buying it out, and the investors can take their cash and they can move on, or they can reinvest in the next opportunity.
Yeah. Okay. Makes sense. Well, Jeremiah, if you could maybe let everybody know, all the audience, where they could find out more about you, if they wanted to maybe get in on some of your, just to find out what you're doing and what you currently have offering.
Yeah. And patriotholdings.com. That's my company's name. And I'm a big Patriot fan in New England, but the problem is we suck now. So, it's a rebuilding period, but it was a dynasty. And that was why I got inspired by that 15, 16 years ago when I opened the company. But you could go on there. It has all our offerings and PPMs and all that stuff. And then also Finding Your Edge, How to Win at the Game of Commercial Real Estate. It is the book I wrote during COVID. I did the Audible book as well about 3 months ago. It's on Audible. It's on Amazon. If you want a copy, it's $10, but you can always email my office. We'll send you one. And I think it gives people good perspective of being a scrappy, small investor trying to go from residential to commercial and all the pitfalls along the way, so you don't make a lot of mistakes I made from not coming from a family that was in real estate or having any expertise in it.
Yeah, I'll definitely probably get the Audible, since I like to listen to them when I run. But I'll definitely get the Audible on that. That sounds like a good one. What about a couple more questions for you, if you have just a minute? With somebody who's maybe just starting out their investment journey, what advice would you give them?
Well, I just read a good book over the weekend called The Psychology of Money. There was another couple courses that reminded me of this philosophy that I took recently. And I would say the advice I would give someone starting out in real estate investing is forget about comparing yourself to anyone else. That is the worst thing you can do when dictating or determining what your investment goals are. So there's only one you, and you decide what is the money going to give you and how do you want to live a fulfilled life before you start putting numbers on the money. Everyone loves passive income. That's what your whole focus is. And I love it too. And that's why we're talking on this podcast. But for me, I think sometimes I get caught up with being successful in real estate, having certain numbers in funds, competing against some other funds, and just whatever. I just get ambitious. But at the end of the day, what is that personal financial goal that you have individually? And then reverse engineer it in terms of, okay, then what's it going to take in terms of my investments to get me there? So you might not need as much money as you think. That's at least what I went through. I mean, it doesn't have to be a lot of money to create, because freedom and independence delivers, and control of your own time delivers the highest amount of probability of happiness and fulfillment. I mean, that is the key, is controlling your own life. Now, it's not going to make you happy, money, but having those three things, freedom, independence, and time, control over your time, you infinitely will have a high probability of being very happy. So for me, you might only need $5,000 or $10,000 or whatever that is a month, $20,000. But at the end of the day, it's not as big of a goal as you think. So if you do it, and if you're willing to do a 10-year timeline on it, and you focus on a bigger time scale, then get a deal under your belt and find out what that cash flow is, or look at passively investing and get a conservative number there. And if you're able to save and keep some cash available and deploy that in ways that will give you that goal, it might not seem so abstract that you have to do all these different things. You might not. You might only need to make 5 to 10 investments over 5 to 10 years and create enough passive income where you can basically you can control all your own time.
Yeah. No, that's great advice. I think that's good. One other question for you, Jeremiah, and that would just be a book recommendation. Obviously, you've already given one so far, but maybe another book. It doesn't necessarily have to be real estate related, but just something that was impactful that you've read recently.
So many good ones. So many. Well, the Psychology of Money was excellent. I mean, I think it's something everyone on this investing podcast can look at. My book, Finding Your Edge, I think is a great book. I hope everyone listens to it. And I'd say, because when I'm an Audible guy too, Keith, and it helps me just passively listen to the story, and I don't have to focus as much on the actual material. I love the book, and I'm not even a tennis fan. It's called Open by Andre Agassi, and it just talks about the mental aspect of building a good team around you, overcoming obstacles, a lot of pressure and conditioning from your parents on, being successful and becoming, independent in who your own identity is and your own goals in your life, and balancing success and pressure. It's just a really well-written book that anyone that wants to, just accelerate in their life and they're dealing with internal conflict. It's just a great story to be able to connect with this person that was quite successful in tennis, but it really relates to any area in life where you're pushing yourself to and trying to get to another level, but you just feel really challenged and conflicted.
Okay. Well, that's the first time somebody's recommended that, and I'll have to check that one out as well. So, Jeremiah, I really appreciate you being on the Wealth Flow today. I think you've provided a ton of value to the listeners. Loved hearing about your story, and so just appreciate you being on the show.
Thanks for having me, Keith. Good, great questions, man. We'll have to do it again.
Yeah, for sure.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.